Hey guys, Mariko Berg, Realtor with Bridgewell Real Estate Group. Today I'm with Kevin Oake from Oake Mortgages, and we're going to be talking about the stress test. But before we get into the nitty-gritty of the stress test, what it is, and how it works, I would like Kevin to introduce himself. So here he is.
Hi there, my name is Kevin Oake. My son and I, Ryan, are owners of Oake Mortgage Services, and we work under the umbrella of Dominion Lending Centers. Happy to be here today and hope I can answer some questions for you, Mariko, and also you, the listener or viewer.
Okay guys, so getting into the stress test, we have a lot of people asking about what the stress test is, how it works, specifically first-time home buyers, and it's something that's really important for you to understand when you are determining what your affordability is. So Kevin, let's just start with basics. What is the stress test in its simplest form?
The stress test is basically a mechanism that the government has imposed with lending rules and guidelines that ensures those that are qualifying for a mortgage have the wherewithal to withstand any rate increases post first term of their mortgage, if you will. So it's really a mechanism to protect you or us, the consumer.
Okay, awesome. And just so you guys know, this was implemented roughly around November of 2017. So just be aware that if you're looking at articles, other blogs, or other vlogs, that you'll just want the most updated information, and that's really what we're trying to provide you with today. So one of the things that's been updated in the past is who it applies to. So can you kind of speak to that about how it's changed over the years?
Yeah, so prior to November 2017, which was on the heels of some significant growth in both Toronto and the Vancouver markets, two of arguably the biggest markets in Canada, there was concerns that we might be coming into a period of inflation where interest rates may skyrocket, and those that had mortgages at 2.59 or 3%, somewhere in that range, may be coming out of their mortgage and rates would be much higher, say in the 4% range. A lot of us in the industry thought that was kind of wild speculation, but nonetheless, it was put in place to protect us, the consumer. So prior to the rule change, we could use, as an example, a first-time home buyer that maybe only had 10% down payment. They could qualify for their mortgage based on the contracted rate of that mortgage. And as I said, it could have been as low as 2.39 for that matter, but probably in the, let's call it 2.7 range back at that point in time. So the thought was, when you came through that 5-year term, that you would have significant or sufficient enough debt repayment or reduction of mortgage principal that when you had to renew your mortgage, you still had enough income to support the new debt at the current rate of mortgages at that point in time. But this fear factor kicked in that we may be coming into this period of massive inflation, and so they changed it right across the board. So any mortgage, whether it was a short-term fixed, a variable rate, or a long-term fixed, you had to qualify based on a 5.34% rate, which again we all thought was like an exorbitant amount based on where we were economically, based on rate of inflation, and so on and so forth. So just a few months ago, that rate dipped back down to 5.19, which isn't a major significant change, but essentially what it did when this new rate was, or new stress test rate was imposed, is it wiped out about 20% of people's affordability. So how the 5.19 works today is that you have to qualify based on your income, based on the size of the mortgage, the amount of your consumer debt. You have to qualify at a mortgage rate of 5.19, and even though your contract rate today would likely be well below 3%. So there's a big gap there that it's really a cushion, and I think they've achieved what they set out to do because the market has slowed and stalled. It did force those people that, particularly in our market in Vancouver, that wanted to maybe buy a downtown Vancouver property for $500,000. Well, now their affordability is reduced to $400,000. So it put a twist in things, and at that same time, the mortgage rates did increase. They did increase, and they peaked in about January of 2019. 5-year fixed rates back then were somewhere in the neighborhood of, I'll call it 3.8, 3.9%. And since January of this year, we've had a major reduction. So now you can get 5-year fixed rates, depending on the type of mortgage, but as low as 2.59, which is almost where they were a couple years ago when they were at their all-time lows. So yeah, the stress test has caused some stress for people, no pun intended, some duress for people trying to get into the market that had been toying with a plan for 2 or 3 years. With today's global economy, the forecasting within the Bank of Canada, where they're going to take their overnight rate, I tend to think that we're going to be in this sub 3% rate environment for a period of time now. And how the government reacts to this will largely depend on how the market bears out and how the general economy bears out. But that's been the effect, and it's been just reduction of affordability, more or less.
So really just breaking it down as a beginner, like if I'm interpreting it as a beginner, really what it is that even though the interest rate is what it is today, you still have to qualify at a higher interest rate just to ensure that you're not overextending yourself in the event that the interest rate goes up by the time that your term ends. Is that right?
Yeah.
Okay. And so you said that it roughly shaves off about 20% of your affordability. I think that a question that I get quite commonly is if there's some way to like work around it or possibly offset. A lot of people have a question between like an A-line lender versus like a private lender when we're talking about the stress test. And so do you have some kind of commentary on like ways that you could maybe find more affordability in other ways given the stress test?
Yeah, there's some mechanisms, but at the end of the day, everybody's going to have a different sort of, they're going to step up to the plate with a different size bat. If your income is more significant, then maybe you're measuring your purchase on your down payment availability. If your income is higher, there may be ways in that, or maybe conversely, you've got a larger down payment and your income is pretty static. I can't say in general there's ways around it because basically there isn't, but if we can look at the overall applicant's situation, again, maybe it's income, maybe it's down payment, maybe it's credit, and maybe it's just their overall debt load, maybe it can be reduced and worked in a different way. There may be a way because the B lender products, they come at a heftier cost in terms of interest rate. And generally they come at a heftier need for down payment. So instead of maybe the 5%, which you can do today, you might need to have 25 or 30%. But there's no sort of yes or no on this. It's all dependent on actually looking at the file of the applicant and measuring out where they're at in today's world with income, down payment, and overall credit.
Awesome. And I think, guys, what you can really get from this is just that it is really, really so important to talk to a mortgage broker beforehand and make sure that you have your team, like your realtor, your mortgage broker, your professionals, all put together really before you start actively searching for things. Because as you can see from what Kevin's saying, there's a lot of different moving parts, whether it be, your income, your down payment, how you get your income, salary, hourly, how you're going to be assessed with regards to the stress test, all of these different things. So it's important that you're working with someone like Kevin or just Kevin,
Ryan,
or Ryan, his son, when you're looking to purchase a property. And so if you have any questions at all, again, my name is Mariko. I'm a realtor with Bridgewell Real Estate Group, and this is Kevin Oake with Oake Mortgages, and we'd be more than happy to help. Kevin is definitely an expert when it comes to building the file, getting your affordability ready, and all of these things. So as I said, if you have any questions, friends, family, or yourself, feel free to reach out to us anytime, and hopefully this vlog helped to kind of explain a little bit better what the stress test is, how it works, and the overall idea of it. So thanks so much for watching, guys. Have a great day.